Here we are. 2026 is here, and our Connell McShane sat down with financial planner Doug Flynn for more on the steps you can take to build up your bank account this year.
NewsNation ringing in the new year with some tips to keep your money working for you in 2026. And we have our favorite certified financial planner, Doug Flynn from Flynn Zito Capital Management, here in our New York studio, which is always a treat. Thank you, Doug.
Thanks,
all right. Happy New Year. Get started here. 2026. Let's do it. You ready?
Yeah. So, perhaps you've gotten a raise, maybe, hopefully.
Yes.
And one of the things that you should do is the contribution limits are higher for IRAs and retirement plans. So what I like to do is say, look, if you got a raise, take half of it, you deserve it, you earned it, but take the other half and bump up your retirement plans. You're not going to miss that new money. It's an easy way to sort of notch up every year.
So you're talking about taking your monthly, whatever you made monthly, now you make a new amount monthly. The first half, you just want to go out to dinner, whatever it is, and then that's the second half.
Yeah, you take the second half, put it away. You never had it in the first place. Even if it's just 1%, just try to notch up something from the new money you never had before. Obviously, you want to try to max it out, but if you can't do that, at least try to notch it up a little bit every single year. Before you know it, you're putting a lot of money away, and that's an easy way to do it.
Well, that's like the word compounding or compound interest over time.
Correct.
Boy, it really is. It sounds simple, but it really is remarkable if you think about it. Just a little bit makes a big difference.
One of my favorite sayings from a wealthy client was, the first million was the hardest.
Right. There you go. But it's true. It doesn't have to be a million, but it could be another.
Exactly. Whatever it is.
Whatever you're starting with, it could be that's
your future. You will thank you. There's no question.
Yes, exactly. Review and update your tax withholding for the new year is second on your list.
Yes.
And we have 6.
So what happens is you might get a big refund or you might owe. And so what you have the opportunity to do is you really don't want either of those. You want to try to get as close to zero as possible. And you can adjust your withholding with the W-4 form. That is the same form you signed the day you got your job, but probably never filled it out again.
Right.
But a quick example is if you owe $1,000 come tax time and have a hard time finding that $1,000, you could change your withholding and bump up, say, have them take out an extra $20 a week throughout the year, which you might not miss, and now you don't owe anything. And so, because that made the $1,000 difference. Or the flip side, if you got a big refund, a lot of people like those refunds, but then you're giving that money to the government the whole year without earning anything. So you can adjust your withholding to get more in your paycheck so that you don't get such a big refund. You got it throughout the year, and you can invest it or spend it or save it.
All right, explain itemizing for us, what we need to know about it, and then how you decide whether or not to do it.
Right, so before the Trump tax cuts, about 70% of the people itemized and 70% took the standard deduction, 30% itemized.
Okay.
Now it's over 90, like 91% of the people take the standard deduction because those standard deduction limits are so high. And so what happens now, people just fall into, well, I took the standard deduction last year, I'm going to take it again. But if you have a lot of deductions, it could be medical, it could be other reasons, don't just think you're going to automatically default to taking the standard deduction. You might want to have your accountant or even you look at whether or not itemizing makes sense. It's just, you have to have a lot of deductions, but it may very well be that is the case.
When does it make sense? Only if you have a high level of deductions.
So if you're like well over $30,000 in deductions, then it will likely make sense to consider itemizing. If you're below that, you're probably going to be in the standard deduction. As a married couple, is about half that if you're single.
Okay. Applying carryovers from prior years. What do you mean by that?
So if you last year cleared out some losses and had some excess losses, you're allowed to take those up to $3,000 on your tax return. But any excess losses carry forward. Now, how you find this out if you did and took those losses is you look in the Schedule D in your tax return. It'll tell you how many carry forward losses you have. That gives you a lot of opportunity to sell some winners with some gains and not pay the tax because it'll offset that, or continue to carry that on every year. But you just want to know, do I have any losses? Of course, you want to get in there and take the losses if you don't feel the stock is going to perform anymore. But that's a great way to make sure that you do know how many losses you have so you can do some better investing with other things.
All right, makes sense. Now, we started this conversation by saying bump up your retirement savings, but also on your list is make IRA or Roth IRA contributions.
Right. So in 2026, the numbers go up to $7,500 from $7,000, and now if you're over 50, 50 and over, you can do an extra $1,100 instead of $1,000. So now you can go $7,500 or $8,600. A lot of people are on these automatic, systematic investment plans.
Yes.
And they might have maxed out to the old numbers. So perhaps change that adjusted amount so that little by little throughout the year you get to the maximum by the end of 2026. But take a look and see where you're doing and see if there's a way way to do that. Of course, I love the Roth because although you don't get a tax deduction now, down the road, having a big fat pile of money that's tax-free and they can't tax you on is a nice thing. You're going to have your deferred money from 401k. Maybe you have a pension. It's nice to have a pile of money that's not going to be taxed.
Okay, well, so all things being equal, people, you know, it seems like, and maybe this is the company influences, I don't know, but the people are favoring, and a lot of companies sponsor 401ks or 401ks. If you had to choose between the two, or would you just not make a choice between Roth IRAs and 401ks, what would you say?
It's a great question. Many plans now have added a Roth 401k feature that allows you to put those higher maximum amounts in a 401k and choose to do the Roth part. Now, you won't get that deduction off your check, but you can put a lot more money into the Roth. I would say all things being equal, if you can forego the tax deduction now, do the Roth. You're going to have a lot more money and tax-free money later on. So if you have that feature in your plan, and if you don't, you can ask your employer to add it. It's very simple to add. You can do the Roth 401k. But if you don't have a plan and you're looking at IRAs, it's the same kind of setup. Do I want the deduction in a traditional, or would I like I won't get the deduction, but do I like that tax-free bucket of money down the road?
All right, that's good, something to consider, even research, you know,
yes,
talk
for
to
your
people
situation.
about it, depending on your individual situation, like you say. And finally, here on your list, number 6 is gathering all of your tax documents, something that seems relatively simple or obvious, but important.
It is, because, and again, if you have a side hustle or you're doing some business, you're self-employed, saving your receipts throughout the year becomes a lot easier to justify the tax write-offs that you're going to get, whether it's travel or whatever. Because a lot of times your accountant will be like, oh, you had some side income. Well, what expenses do we have to offset it? And you're scrambling to find that, so you might be paying more tax. So this is whether you have your tax things coming in early January and February that say important tax document, put that in an envelope, obviously, for your taxes. But also throughout the year, getting to the habit of just putting all that stuff in for those people that have a side income, because you might be able to write off some of those expenses, and it's a lot easier if you have the receipts compiled already. Yeah.
Bring the receipts, they always say. Keep the receipts. All right, Doug Flynn, a huge part of the show in 2025, and he will be as well, I hope, in 2026, because he speaks English about these things, about the financial matters. So thanks for doing this, and thanks for everything. We always appreciate it.
Thank you.